What's the outlook for banks is the question, and let's put that to Nitin Aggarwal, one of the senior most analysts as far as BFSI goes. He's head of BFSI Institutional Equities at Motilal Oswal Financial Services. Nitin, good to have you with us here. Thanks very much for your time. You know, I was thinking about the conversation on broader banking trends we had with the management of Punjab National Bank just yesterday, and they seemed, the outlook, etc., pretty robust overall. Most bullish on sectors like MSME, self-help groups. I mean, at least that is what they see for PNB. What is your sense? Let me just get a broader kind of number out of the way first. Do you expect credit growth to pick up, which is under 10% now? It's steep. It's sharply lower as compared to where we were about a year ago. Do you expect any bump up through the course of this year?
Yeah, hi, thanks for having me. So on credit growth, we think that right now, yes, we have come down to 9%, single-digit number. Our estimate for the year is somewhere around 11%, but there is a risk that this may remain range-bound, and 10-11 may be a good case to expect. And recovery whatsoever will likely be back-ended, because in the near term, given all the moderation we have seen in the bond yields, some credit substitution will happen. So some demand from bank borrowings will shift to bond markets. And there is a possibility that given how the currency has been stable, US may look to cut interest rates. So all-in hedge cost of foreign currency borrowings may also moderate. So to that extent, there will be pressure that will continue on credit growth in the near term. And probably towards the end of the year, as some reprieve comes in form of some pickup in consumption, because given the lower rates, benefits from the reduced tax rate this year, you may see some pickup in the retail growth later during the year. So which is where we still hope that we will still end the year somewhere close to 11% credit growth. 11%
credit growth. Got that. That'll be an improvement from what we're seeing right now, Nitin. Good morning and thanks a lot for coming on the show. Well, you mentioned that banks holding higher EBLR, a share, they will get harder hit. If you could tell us which are those banks?
Yeah. So yes, given the sharp easing in repo rates that we have seen, 100 basis point easing, so there will be impact on banks' advances yields, and banks with higher linkages to repo rate will see a bigger hit. So within that bracket, you can look at many private banks, all the top names, wherein the repo linkages are between 40 to 50% of their portfolios. And overall, the floating rate portfolios are somewhere closer to 70%. So which is where the margin compression will be at its peak in Q2. And thereafter, we will likely see some stability emerging from Q3 and Q4 onwards. We will start seeing a positive delta on margin line.
Yeah, and I think that's exactly what the SBI chairman also told us, Nitin, that with the CRR cushion coming in September onwards, there will be a good recovery on margins as well. So it will be a U-shaped trajectory for margins. That's what he told us the day the monetary policy cuts were announced. So now the question, Nitin, is really what to play here. Should one be, are you better off with the larger banks? Should you look at NBFCs? It's a very wide universe of lenders. So where would you put the money over the course of the next 12 months?
Right. So in this report, we mainly talked about banks because that's a banking sector report, wherein we have maintained our preference for the larger banks. So ICICI, HDFC Bank, amongst the private banks, remains the preferred play, wherein we think that these banks, given the strong liability franchise, are still better positioned to manage the overall earnings and deliver a healthy outlook. I think FY27 will be a great year for banks. We have already seen last 4 years of earning compression, every year turning out to be lower in terms of earning growth than the previous year. And this trend will break sometime in FY26. We believe that 1H earning will be just flat on a YY basis, and then 2H will be roughly closer to double digits. And thereafter, it will recover back to 18-20% kind of growth in FY27 for private banks. And so to that extent, I think these private names still look good to us on PSUs. You will see continued challenges around the ROA line. And I think the ROAs have peaked, and at best, they will look to maintain the ROAs. But that may also be from FY27 only, not in FY26.
All right, Nitin, before we let you go, what is your top pick? And you must tell us what is your view on Indescent Bank. There's a very, very strong bullish and a very, very strong bearish argument as well. Which camp are you in?
So I think Indescent Bank is beginning to see some visibility or some stability as to given how the recent developments have been. A lot of, I think the street estimates, even the price targets, multiples have approached the bear zone multiples, including ours. But now as the drag, at least from the uncertainties, goes away, and you can look at the numbers and forecast them on an operational basis. Of course, there will still be some softness on margins, on growth in the near term, but at least there are no one-offs. Last quarter, one-offs were pretty high in terms of the number of one-offs also that were there. So if those one-offs go away, at least you can take a more closer look and place a valuation call onto the operational parameters and that you are forecasting. So which is where the stock still trades like closer to one-time trailing and below one time when you look at forward basis. So I think as the stability comes in, new CEO appointment should happen in the next couple of months. The bank has to submit the name by this month end. And post that, we will get more clarity as to what is the priorities that the new management adopts, and which is where I think you will see more interest. As of now, we have maintained a neutral stance on the bank.
Okay, so you're still being a little cautious, still neutral on it. You'll probably revisit that call once there's clarity on the new management. Got that point? Good speaking with you this morning. Thanks so much for joining in. Slightly shorter call, but it was a very fruitful one.